Welcome to the Valuation Desk by Highland Global, where SBA business valuations speak bank. In this session, I'm excited to tackle a topic that sparks confusion in business acquisitions: the difference between price and value. These terms sound similar, but for SBA 7A lending, they're worlds apart. Mixing them up can lead to underwriting issues, compliance headaches, or bad deals. Let's break down what price and value mean, why they diverge, and how they shape SBA 7A loans. What is value? Value in business appraisals for SBA loans means fair market value. That's the price a business would fetch between a willing buyer and seller, both fully informed, neither forced to act, per IRS Revenue Ruling 59-60. Appraisers assume a hypothetical financial buyer and no emotional bias or special perks. Fair market value is objective, often calculated using the capitalization of earnings method, and it's the cornerstone of SBA 7A valuations. What is price? Price is the actual dollar amount in a purchase agreement set by real buyers and sellers with their unique motivations. Maybe the buyer sees big cost savings, loves the brand, or needs to relocate. Price reflects negotiations, emotions, and deal terms. It's subjective and can stray far from fair market value, creating challenges for SBA 7A financing. Why do price and value diverge? Several factors pull price and value apart. First, synergies. Strategic buyers pay premiums for benefits like cost savings from merging operations or increased market share. Second, personal motivations, like buying a childhood favorite restaurant, drive emotional premiums. Third, deal structure. Generous seller financing or earnouts can inflate price. Finally, limited market exposure without broad marketing may skew price away from fair market value. These gaps matter for SBA 7A lenders. Appraisers, often using the capitalization of earnings method, focus on fair market value, not the agreed price. If fair market value is lower, say $800,000 versus a $1 million price, the lender finances only a portion of the $800,000. Above that, the buyer needs additional equity or seller notes subordinate to the lender. For lenders, the price-value distinction ensures SOP compliance, cuts loan loss risks, and guides deal structuring. Buyers avoid overpaying by separating financial value from emotional pull or synergies. Value is your compass, objective and market-based. Price is the path, subjective and deal-driven. For SBA 7A loans, fair market value keeps financing grounded, while price reflects real-world choices. An appraiser's fair market value is critical for sound SBA 7A loans and smart deals. Thanks for joining us for this episode of the Valuation Desk. When you need clarity, confidence, and credibility, experience makes all the difference. At Highland Global, every appraisal is backed by decades of expertise and thousands of completed reports. We don't just crunch numbers. We provide insight, context, and defensible conclusions that lenders can count on. Whether it's a business acquisition or equipment appraisal, our seasoned approach helps ensure your deal moves forward with precision and trust. For more information on valuation-related topics, be sure to visit our website, highlandglobal.com. Lenders know experience matters most.